Hi, everyone. Thank you very much for being with us today. I'm Adam Newman. I'm a senior wealth advisor with the firm, and I'll be joined by Andy Pratt, our director of investment strategy. As you all know, we typically conduct these webinars on a quarterly basis, but in this instance, we felt it would be timely just to touch base with clients, given the events of the past couple of weeks, and also in response to a lot of the common questions that our advisors have been fielding. So first, we'd certainly like to acknowledge that while we all know the benefits of being a long-term investor in the stock markets, short-term volatility can be very uncomfortable. So our brains have significantly different responses to market declines when we compare them to how we react and how we're thinking during market rallies, mostly because we tend to have short-term memories when evaluating these past market experiences and also our emotional responses. So we often say that, our brains have had millions of years to evolve to the risk-reward trade-off in life, but we only have several hundred years of market history. So there is a disconnect, and it causes our, reactions to tend to be, significant based on these past experiences. So this is why, in many instances, when we look back at past recessions and bear markets, they look like the investment opportunities of a lifetime through the rearview mirror. Yet a correction today or a small drop in the market today inflicts pain and worry. This is really driven by those four most dangerous words in investing. This time is different. Today, we could say it's the volatile political environment. We could say it's the Fed manipulating interest rates. It's the algorithmic traders moving markets. So it's very easy to be thrown off each day by the crisis du jour if we let ourselves. Not helping the fact is the idea that we live in a time where an unlimited amount of information is at our fingertips at all hours of the day. This makes it particularly challenging to tune out the noise, even when we know it might not be relevant to our long-term investment plan. So again, when I think about the reason for holding this webinar and creating this line of communication is it really becomes our job to help you tune out the noise and provide timely perspective and guidance. So during our conversation, we're going to revisit what happened in the month of February and why. We're going to take a look back and provide some historical perspective on market declines, and also look ahead to the actions that we believe should and should not be taken. I'll end up passing it over to Andy some way about the halfway mark. So here we have a summary of various market returns during the month of February. This captures the events leading up to and including the sharp sell-off that we saw last week, which, as you might have heard, was on record as one of the quickest 10% drops we've had, and especially in the last 10 years, it was the sharpest that we've had. So you'll notice that while there's some slight variation in returns by specific asset class, it was very much so a global and market-wide sell-off. You'll also notice how the fixed income markets, as proxied by the Barclays Aggregate Bond Index at the bottom, held up fairly well, mainly due to a sharp decline in interest rates. So when you have periods where equity markets are volatile, there's a tend to sell out of equities and buy fixed income. This pushes rates down and pushes bond prices upwards. And yesterday, the 10-year Treasury note was all over the headlines because it fell below 1% for the first time in history. So it's amazing to think that the government could borrow for 10 years for less than 1%, when only a handful of years ago, and especially prior to the financial crisis, we saw mid and high single-digit rates on the 10-year. So our clients who have some level of exposure to fixed income did end up feeling a little bit less of the pain than those fully exposed to equities. And that's neither good or bad. It really depends on your circumstances and your time horizon for investing. But we'll reinforce in a bit some of the considerations that go into why you should not diversify out of stocks. But this is a good snapshot just to understand and capture the returns that we were seeing through the month. You turn on CNBC, you turn on any, look for any news headline, you hear words like crash, tumble, crumble, whatever that the panic-stricken word of the day can be. And you might think that those numbers are a lot more significant than this, but this helps capture the reality of what happened. And certainly we're seeing that change through the month of March with some still large daily ups and down swings. We're certainly not out of the woods yet in terms of the volatility. So looking at last month in particular, the past couple of weeks, how does this compare to some of the more recent market corrections that we've experienced? So while a lot has been made of the lack of volatility in the market since the bottom of the financial crisis, there's actually been 26 market declines of over 5% in the past 10 years. So here is a good chart that was recently distributed as a blog post, and it shows each of these 26 correction periods, as we call them, the number of days that this correction persisted over from top to bottom, and then the percentage declines that investors experience. So next to each of these incidents is a good descriptor of the headline of the day. So if we think about staying invested, if I'm reading off these events in this list, many of these might appear to be acceptable reasons to play defense in your portfolio. But as we know, and as the numbers support, all of them prove to be short-term traps for undisciplined investors as the markets continue to grind higher. So under each of these specific cases, I could attach those 4 words. This time is different. So let's look at what initiated the most recent market decline. I find myself telling clients that unfortunately for us, markets don't speak. So each day there's millions of market participants looking to buy and sell, all with their own unique reasons to transact. And the investment community, the financial press, they are forced to attach a headline to these dailies up and downs to keep our interest and sell ad space. But on most days, the reality is we're keenly unaware of the driver behind market activity. In some cases, it can be a lot more obvious than others. So I think in this particular instance, we can say with some level of confidence that the recent correction was driven by the uncertainty created from the global spread of the coronavirus. And so while there's always some level of uncertainty in markets, we'll oftentimes see quick spikes in uncertainty without warning. So uncertainty is always there, but when it escalates and it spikes quickly without much of a lead time, they're very natural for there to be an overreaction from investors. So these external shocks, as we call them, they are typically short-term in nature and take some time to play out, but should very much so be expected and we think seen as a healthy way to keep market prices honest. An added wrinkle, though, to market movements, especially in the past few years, has been the role that central banks globally have been playing in trying to calm investors and provide reassurance. So domestically, the Federal Reserve, if you go on their website, if you research, what's the role of the Federal Reserve, they really have 3 main responsibilities. The first is to promote maximum employment in the economy. So we think, where we are today, we still have a very healthy labor market, and that's been a trend that's continued. Their second job is to maintain stable prices, and that's not equity prices, that's stable prices through the lens of inflation. So they have to keep inflation low. They have this 2% inflation target that they use as a benchmark to determine, is inflation around where it should be? Is it too high, too low? So they need to manage that. And the third is they need to moderate the long-term interest rates in the economy. So that's their job on paper. But since the financial crisis, they have certainly taken a more active role in the markets, whether they would want to admit that or not, which has helped set sentiment here and there. You see markets react on rate decisions and the messaging that they're providing to the markets. But it certainly does not address the root of all problems. And that's very much so the case in this instance. So the Fed can cut benchmark interest rates, which they did yesterday morning, right around 10 o'clock Eastern time. They shot out that they were lowering rates by 50 basis points. And they can do that as a way to get in front of the economic uncertainty, but they obviously can't be relied upon to contain and later even cure the virus. So they're acting in anticipation of potential economic headwinds, but their actions do not alleviate the problem at hand, and we know that. So That doesn't mean that we should change our investment decisions because the Fed can't take the wheel and save us. It just means that eventually that there's going to need to be assistance from other places. And we're going to leave that to the medical professionals and those that are better equipped to comment on the solution and maybe the list of things and actions that could be taken to address the virus itself. But in the meantime, we're just going to acknowledge the fact that there's uncertainty. There's a heightened level of uncertainty, and regardless of its cause at any point in time, uncertainty is the rule and not the exception when it comes to investing in equities for the long term. So, now we have to ask ourselves, where do we go from here? Where do markets go from here? And just as we look backwards as prior bear markets, corrections, tougher market environments, history also can provide good insight into how markets revert course after corrections and after short-term shocks. So since 1929, so we've got quite a bit of history of the markets, and we're going to proxy the market with the S&P 500. They've done a remarkable job at changing direction and refocusing on fundamentals, which we know the fundamentals of the economy and the fundamentals of the companies that we choose to invest in are going to be the long-term drivers of our investment success and outcomes. So while all recoveries come in different shapes and sizes, the overall message is the same. It's usually not a good decision to bet against the long-term prospects of the U.S. economy and markets, no matter how scary things appear today. So this is, just good supporting evidence of that. And our team, the advisors that you work with on our team, are happy to provide any additional context you might want behind these numbers and maybe the various underlying time periods between them and their behavior. And so this is a great time when you run into market corrections, market movements or uncertainty, and you're feeling uneasy and you're wondering what action should be taken. We always think we want to lead with questions. So here are some questions before I pass it over to Andy that I really think that we should be asking ourselves as investors right now. The first is, have my goals and or time horizon changed? So someone who needs access to their funds in 1 to 3 years and is riding through this market volatility is going to feel and behave much differently than someone who knows that their investments at work are long-term dollars, dollars that we're not going to need anytime in the near future. So your attention can be focused on what's happening in the markets, and it can be interesting, and we can evaluate it. But as a long-term investor, your goals and circumstances really need to be lined up with the level of risk that you're taking and your time horizon. So this is a great touch point. If you felt like in 08, 09, you rid it out and you didn't have any issues, but now you're feeling uneasy because retirement's coming around the corner, that's a great conversation to have with one of the professionals on our team because that might warrant some changes in the amount of risk we're taking in your portfolio. So that's the first thing. What does this mean to me personally? Number two, be very aware of the different behavioral biases that we can fall prey to as investors and try and identify if any of them are working against you. So there are 3 significant behavioral biases that we point out quite often and that are prevalent in the markets. The first is recency bias, which is perfect in this instance. Recency bias means that when markets are going up, we think they're going up forever. And when markets are going down, we think they're going down forever. It's this thought that whatever's happening now is what's going to continue. So that's something that when the markets are going up, we probably don't notice as much. But when we're in periods of downward volatility, it can tend to feel like, we need to stop the bleeding, or that markets are just going to, there's no bottom, that there's just going to be a precipitous decline. So that's number one. Number two is overconfidence. And I'll apply that in this instance. Overconfidence is really our desire to take control of the wheel and really have confidence in our investment outcomes and how that translates to our ability as investors. So overconfidence today would be trying to sell out and time the start of a market drop and then get back in at the perfect time only to ride things higher. So overconfidence in this instance would be our thought that we can somehow time the markets, which we know is not true. And then third is loss aversion. How do I prevent myself from experiencing investment losses? What are the types of losses I can handle? And, what does that mean, for me and my portfolio? So as I said in my opening comments, we're much more, we are excited when markets are going up and we have gains, but as humans, we're wired to stay clear of danger. And when it comes to our money, there's no greater danger than short-term market sell-offs. And so we do what we can in a lot of cases to try and prevent that. So the way that you tackle numbers 1 and 2 on this list is to have a formal investment plan. So those that do not have a plan for their portfolios, the risks they're taking, and do not have a clear understanding of how their objectives need to line up with their investments, those are the ones that are typically overreacting in these cases and making decisions based on emotion and not based on facts. So that's some context on what's happened, the historical nature of what we're seeing, and some of the questions we think you should be asking to yourself and with your advisor. And I think this is a good time to pass it over to Andy to speak more specifically about what we're doing, what we're thinking, and the actions we think should be taken.
Great, thank you, Adam. So as Adam mentioned at the start, my title here is Director of Investment Strategy. And what that means is that my team and I every day are looking at all of our portfolios, evaluating the investments that are in them and figuring out, when we should or should not be making changes. So I wanted to take a moment on this webinar to discuss both the things that we are doing in response and the things that we aren't doing in response to the most recent market volatility. I wanted to start by talking about all the things that we are not doing during market corrections. And before I get there, I certainly understand the fear that comes with sharp market declines. I think in this case, we're talking about there's an entire human element here with people getting sick, people dying, and that's scary. And then when we couple that with the fact that markets are selling off by 4 or 5% in a day, 12, 13% over the course of a week, that certainly is a terrifying time. And so when these types of things happen, we get questions like, should we go to cash? Should we stop the bleeding? Should we wait it out? And those oftentimes, happen right as things are getting to their worst points. So certainly on Friday, we were seeing quite a few of these questions. But the thing about markets is they're really good at anticipating and pricing in known risks. But when we have some sort of an external shock like a virus and a pandemic spreading worldwide, that's when there's uncertainty. And with uncertainty comes oftentimes big reactions in the market. So we don't know when the volatility is going to stop. We don't know how low markets can go when we see this type of volatility. But we can look to some other spots. So one way to look is past market corrections. So the most recent one happened in 2018. And that was a little different because it was a little bit unclear what the actual cause of the correction was. But it was marked by a sharp decline followed by a V-shaped recovery. And I saw that there was a question in the chat here as we were going along as to, when we see 10% corrections, how quickly do markets tend to recover? And certainly we don't know when they're going to recover following a 10% correction. But a common thing we see is a V-shaped recovery where markets sell sharply lower and they bounce back pretty quickly as well. And the reason for that is volatility tends to be mean reverting. So right now we're seeing VIX numbers, they peaked up in the 40s, in the upper 40s. Typically volatility falls. And when volatility falls, that's when stock markets, increase in value. So we don't know how long we're going to see above average volatility. But when it does go the other direction, it tends to move sharply. And if you've been investing for long enough, you've certainly seen the stat where if you miss the top 10, trading days over, some sort of a time frame, you missed out on a big percentage of the excess returns promised by stocks. And that's certainly true. But one thing that maybe isn't as well known is that most of these top 10 trading days tend to occur in the immediate aftermath of corrections. So oftentimes what we see is if you do pull the plug and go to cash right in the midst of a market sell-off, it's typically very difficult to get back in before one of those top trading days in the market. So with your investments, the better thing to do actually is to stay invested and keep in mind that volatility and risk, this is the price that we pay for the excess returns offered by stocks. It's more of an emotional risk. It's something that is stressful and can affect us kind of outside of the dollars and cents, but that is the price we pay for the long-term stock returns. And another frequent question we get is, what kind of, directional bets can we make? Are there certain economic sectors that we think are going to benefit or do worse, or should we be rotating into asset classes like bonds? And, ahead of this one, there might have been a common question like, well, maybe we should go to bonds because we anticipate the Federal Reserve to lower rates. But typically what happens is when we try to take stands on which economic sectors are going to do better or worse, or which markets are going to do better or worse, we're oftentimes wrong. I liken this to changing lanes when you're stuck in traffic, right? So the lane to your left might be moving fast right now, so you hop over just in time for the lane you were in to surge ahead. And that's typically what we've seen when we see people try to make these types of directional bets on the markets. For instance, Adam mentioned that long-term bonds, which are not directly linked to the Federal Reserve, had already fallen well before stocks had fallen. So if you were trying to move out of stocks to get into bonds, well, you've already missed out on the move higher that bonds perform based on falling interest rates. So all in all, what we want to do is we want to try to avoid taking action in our portfolio during times of market stress. And the reason is this is the long-term time horizon for stocks. Adam wrote a blog post last week. I published one this week. So quick aside, if you're not checking out our blog, we do try to update that, weekly and provide topics that you might be interested in. We don't always send an email out when we post because we don't want to spam you. We want to be respectful of your email inboxes. But we are always posting on our social media. So if you want to follow along, what we have to say in between these webinars and maybe in between calls with your advisors, follow us on Facebook, follow us on Twitter, LinkedIn. You can subscribe to our YouTube channel, and you can get the most up-to-date communications that we have there. So this was a chart that I included in my most recent blog post, and I wanted to make the point because Warren Buffett was on CNBC at the beginning of last week, just in time for the coronavirus fears to spread, and he had really good advice for investors. He said, don't sell today based on today's headlines, right? So don't sell your companies based on today's headlines. And that's really good advice because if you're invested in stocks, whether that's your entire asset allocation or if it's part of your overall strategic asset allocation, you should have a long-term time horizon. That might mean 10 years, that might mean 20 years. I'd make the argument that for many of us, that means 30 years. For people who are employed, many of us still have at least 30 years to go before retirement. For people who are nearing retirement, you're still planning on your portfolio lasting you another 30 years. So when we're talking about investing in stocks, this is really sort of the time frame that I have in mind as part of the asset allocation. So I've got the legend here on this, but if I were to ask you, what do you think the price of stocks were as based on the S&P 500 30 years ago? Today, the S&P 500 is around 3,000. It was about 3050 earlier this morning. I think most people might guess 30 years, maybe it was 1,000 points. But the truth is, it was just 350 points 30 years ago. So that's, this is inside almost all of our lifetimes here on this call. And can you imagine investing in something at 350 that is now worth 3050? So when we talk about, what we're not doing in a portfolio, this is why we're not doing it. We want to make sure that we're invested and we're able to capitalize on this full return stream, no matter how good or bad things are getting. But I also like to be positive in these talks. So there are some things we can control and some things that we are actively doing during corrections. A big thing that is sort of a silver lining in all of this is that we now have an opportunity to take some losses and do some tax loss harvesting. It's great when the stock market goes up 30% in a year, but that leads to problems where, there's almost nothing in your portfolio that is at a loss. So for making any sort of tactical adjustments, which we have recently as we tilt towards value and we expect value stocks to outperform over the next 12 months to 2 years. That means that we can't do it in as tax efficient a way as we'd like. So whenever we see a sell-off like this does give us an opportunity to offset some of those gains we may have taken earlier in the year with some new losses. And another thing we can control is rebalancing. So I mentioned that many of us on this call have a strategic asset allocation where we're mixing risky assets and less risky assets like stocks and bonds. So when there's a big market sell-off, that can tilt our asset allocation out of balance. So now, your bonds, which held up and actually gained 3% over the course of this month while all the stocks were falling, you may now have too high of an allocation to bonds relative to your asset allocation. So one way that we can actually add value is rebalance away from bonds and into stocks with their temporarily depressed prices, right? So rebalancing kind of forces us to trade at optimal times. As we know, over the long term, stocks and bonds are going to revert back to their long-term average return. So when we have these types of opportunities, this is where rebalancing can really help. The other thing we can do is we can revisit our risk profile. So, I know we've got some clients on this call who just tapped into our investment management services, but we have others who go through a full financial plan. And as part of that plan, there's a risk questionnaire that determines, what is your personal tolerance for risk. But one of the problems with these questionnaires is they're just that, a questionnaire. And it's very difficult for us to think about how we'll actually react when markets start falling. In psychology, there's this concept of cold states and hot states. And so typically we're calm, and that's called a cold state, right? So, but if you've ever done something, while you're angry or while you're upset, or maybe while you're watching a sporting event, something you said, something you did, maybe you were in traffic and you got aggressive to the driver next to you, I don't know. You probably can't imagine doing that when you're calm. But sometimes when we're in the moment, our emotions get the best of us. So when markets do sell off, that creates a hot state, which allows us to more accurately determine what our actual risk tolerance levels are. So this is a great time to revisit, how am I feeling? How am I reacting? What are my emotions right now while my account is down? And then we can incorporate that later once markets recover. And the big thing that we want to emphasize is communicating. And I'll get to that here on my next slide. This is another blog post that we did. We did this probably about a year ago during the market sell-off of 2018, and we repost it through time. So I wanted to leave you guys before we end this with 4 strategies for dealing with market sell-offs. And the first one is a big one. If you're invested in stocks, you should expect volatility. This, as I mentioned before, is the price that we pay as long-term stock market investors for the long-term excess returns promised by stocks. If you go into, anticipating that a 10% correction is going to happen about as frequently as you have a birthday, that makes it a lot easier to stomach when we inevitably do get these sell-offs. The second bullet point here, I often get quite a bit of pushback on, but it is sound advice. So what we want to do is we want to avoid frequently checking on our investments. Adam referenced earlier our disproportionate responses to gains and losses. Simply put, we feel losses more than we feel gains. So we're more upset by losses than we enjoy gains that we have in our portfolio. So if you're frequently checking your portfolio daily, weekly, whatever that time frame may be, then you're ultimately, even if you see about 50% of the time your portfolio is up and about 50% of the time your portfolio is down, well, you're going to be impacted by those losses far more than the gains. And especially when stock markets are declining, we have the urge to check in to see what we're doing. But one of the best things you can do is simply put your head in the sand like an ostrich and stay away from your investments. I think that you don't want to check in too infrequently, right? So if you want to check in annually or even quarterly when we send you your packets, that's probably something you want to do to stay involved with your portfolio. But we certainly want to avoid over-checking. And then the other thing we want to do is we want to avoid all or nothing decisions. So we were in our cold state when we did our original asset allocation, but now we're in our hot state. And we're freaking out more than we thought we would. Well, it's a false choice when we think about going completely to cash versus completely invested. So if things do prove to be too stressful, you can make tweaks in the process where maybe you're taking some of the risk off the table. This is not as optimal as staying fully invested, but it's a lot better than going all the way to cash and potentially missing out on a quick market recovery. And the last thing that we want to emphasize is talk about it. Money can be hard, especially when we're dealing with losses. It can be difficult to talk about, but advisors earn their value during market sell-offs by offering calm and reasoned advice. I don't think that when this is happening, there's any question that we would consider a dumb question. We would rather hear from you than not, so that we could help walk you through the decision. Sometimes, when we're making knee-jerk decisions, just simply having someone to talk to who can listen to you, who can empathize with you, and then guide you towards, maybe staying in the market. And making better decisions with the portfolio, that type of advice is valuable. Pulling the trigger and going to cash and missing out on returns is a lot more expensive. So we want to make sure that that our advisors are more than eager to talk to you. So we appreciate everyone attending the webinar. We wanted to keep this thing right at 30 minutes because we know that it's the middle of the week and this is a lunch break for many of you. So we hope that we answered some of your questions here. And we also hope that we prompted new ones. I know that there's some questions that came in the chat, and we'll certainly respond to those offline. But please, if you've got any questions, whether you ask them in the chat or not, please reach out to your advisor and further the discussion. Thank you, and have a good rest of the week.